Today is April 24, 12:10 p.m. We detected unusual options on medical properties. Ticker symbol MPW. And keep in mind, earnings is coming up on April 27 this week. It has dropped 2.7% as of now. And so, as usual, let's get right into those unusual options. So you'll see here this 9:41 a.m. for the Junes, this 6 strike puts, 2,999 of them. This was quite unusual. The other one that was actually also unusual was this one. It shows up here at 11:16. This was done just less than an hour ago. So make sure you hit that bell icon if you're subscribed so you get the notifications right away. These actually expire right after earnings. So this was also very unusual to us. So let's deep dive into these two unusual options that we are. They're actually today's biggest. Right here, you'll see. We're going to take a look at both of these. So for the first one, this April 28, okay? Over here, you'll see it right here, the 7.5s here. You'll see here that the volume of 500 is actually greater than the open interest. So this is an opening order. And what we believe they're doing is they're selling this call. And that is moderately bearish. You'll see here the current price of 68 is, you could sell it for 68. And if you look at that price, they actually also executed at 68. That's another reason why we know this is, we feel like this is a sell order. And so when you take that and you sell that, you'll see here why it's moderately bearish. You'll see here that as the price goes down from 8 on the x-axis, the profit will go up, right, from 0. So this is potentially, it limits their profit though because they're just selling a call. But what this could really be is actually they have stock in this company, and so they're selling these calls to collect a premium for the higher volatility right before earnings and to kind of reduce their loss if the stock goes down. So they have a, for example, if they had 100 shares of this stock and they sold one of those calls, you could see that it is actually a, let's say they have 100 shares. The current price of 8.09, if the price goes down, it could go all the way down to here at break even to 7.4, and they will not be at a loss. Their stock will not be at a loss. And so that's what they're doing, is selling that to create a covered call. So they don't expect the price to rally. That's why it's limited in profit. But it is welcome because they will still get to keep that. They will still have that profit from their stocks. They will, so so that's what this is. I believe they're risk managing here by selling those 7.5 calls. So the other unusual options, a very large one, the 2,999 of them. This is done in June 16, you'll see here. And what is that? That's the one that we're actually in this one. You'll see here our position. The volume here is now 7,900. This is much greater than the open interest here, right? So we know these are open orders, and this is buying the 6 strikes puts here. And so if you buy one of these, they're going for $25. You'll see here that it will profit as we move down, as the price drops. It will be above that zero line, right? And we went over, well, we took this trade because usually we like to also have a second option contract, but because of the theta decay, but this theta decay actually isn't very high. It's negative 0.6 because we're actually 53 days away. So the theta decay is not as negative. So that's why we took this trade, and we can close our position if it doesn't seem to be going down after earnings, and still reduce our risk there because we still have time. And it's also quite possible that the large institution that had the shares and did a covered call, they could have also bought some of these 6 strike puts to reduce their risk. You'll see as they increase more of these. Let's say they bought 2 of these or 3 of these. Then if the price goes down, they're actually never at a loss. This line will always be above 0. So they can keep their 100 shares of stock and still be okay and be basically profitable. So keep that in mind too, that these 6 strike puts could have been done by that same large institution. We don't know for sure because they were done at different times. That is our analysis on medical properties, and we are expecting a potential drop after earnings. Let's look at it from a 3-year perspective. You'll see a big drop here, and so it looks like the company is not doing very well, and so the trend is down. And so if you are following the trend, then we are expecting a further down movement here by that expiration. Okay. All right. Well, that's our analysis. If it was helpful, please smash that like button, and please give that subscribe button also a consideration, and hit that bell icon, and you'll be notified whenever we see unusual options. Thank you, and take care.